Welcome to the Money Pig podcast, presented by Goodwin Investment Advisory, where our mission is to lead you to financial pig, peace, independence, and generosity. I'm your host, Tim Goodwin. And welcome back to the Money Pig podcast. We are so very excited to have the only Justin Pitcock back in the studio with us today. How you doing, Justin? Wonderful. So, and I would be remiss to not acknowledge that we have Notorious BIG right here supervising us to make sure that we
peace, independence, and generosity.
All right. So today we are talking about understanding the new tax law, what the OBBBA could mean for you. But before we do, Justin,
what does it mean? What does that mean to you?
What does it mean to me? I'm kind of hoping that you could tell me more about what it means. So mostly just talking to ChatGPT about it. But I'm glad that we're going to unpack it here audibly for our listeners. Before we do, though, Justin, can you share maybe something interesting about you that the audience may not know?
So I was thinking about the OBBBA.
Were you? Okay.
And I'm a hunter, and so we use triple B shot for goose hunting.
Okay.
And so
you can come to my house. You can take out all these geese pooping all over my driveway.
Yeah.
Oh my goodness.
This is
Triple B
excited
shot
for this winter. And
okay. That's when season is around here. I hear that, a nice goose cooked right can be very delicious. Is that true? No,
there's
a stretch.
You can cook them where they taste good.
Okay.
But they're not the easiest thing to cook.
Gotcha.
It's
would you rather be cooking some deer meat or some boar meat?
Oh yeah, much better.
Much better.
Yeah.
Okay.
Although if you marinate it, cook it like a steak, medium rare, like it can be pretty good.
Okay. All right. That's what it takes.
Yep.
Good to know. I'm getting tempted to eat some of these geese on my own property. So, so I don't know if we talked about this. Do you regularly go to a chiropractor?
No,
you don't.
I probably should though.
Well, I never believed in my chiropractor, but now I stand corrected.
Yeah. So.
Because he adjusted my spine, Justin.
I get it.
Oh my goodness. Sorry, that was the dad joke right there. Obviously, the listeners are like, oh, it's brutal. Let's get past this. So just trying to keep it live and entertaining here before we just dive deep into tax law. So, all right. So the one big, beautiful bill, I think I'm missing a B. What am I missing? Big, beautiful bill. There it is. Yep. There it is.
Bill
so,
act.
There it is. The A. So tell us about this. What does this mean for us, Justin? Why is this important?
So it's saving. I mean, I run tax scenarios for a lot of our clients, and in our planning software, there's been this setting where it's like you can extend the way the tax brackets have been.
Right. Because they were set to expire.
They were set to expire. They were going to sunset. Yeah. We were going to be taxed the way we used to be before the current tax code.
That's a really good point. Like whether if you have a financial advisor up to this point, whether it was us or somebody else, they've had to make this decision in your financial plans. Do I just say the tax environment stays the same and these cuts remain or not?
Right.
Because
so
just a guess.
Pre-Tax Cuts and Jobs Act, like the tax code for most of our clients would have resulted in higher tax.
Mm-hmm.
And so the fact that we're getting to keep the same tax brackets that we've had since the Tax Cuts and Jobs Act is very beneficial. And that's just by itself saving most of our clients between $3,000 and $6,000
a year.
A year
in taxes.
Yeah. Just because we're missing the 28% tax bracket, which is where a lot of our clients would have otherwise been. And so they would have a substantial part of their income taxed at 28%. Now all that income is taxed at 24%.
Interesting.
That's the way it's been taxed. That's the way it will continue to be taxed.
When we were having to decide to project the tax environment for the future for our clients and their plans, we wanted this tax cut, this Jobs Act to stay.
We wanted the
we
current
knew it was
tax
saving
rates.
our
Yes,
clients taxes, which is improving their forecasts.
So
right?
the biggest thing this bill accomplished is just keeping the same tax rates we've had under Tax Cuts and Jobs Act. I think that's probably the most beneficial across the board.
Otherwise, there would have been an increase for a lot of people.
For a lot of folks. The other thing's the standard deduction. So we actually got a small inflation adjustment. And earlier this year, before the OBBBA passed, it was slightly lower, and I think it's like $750 per individual. That it's higher now thanks to the passage of this bill than it was under, or what we were thinking it was going to be earlier this year.
Yeah.
So for a couple filing joint, that's another $1,500.
So what's the total now for a couple filing jointly? Standard deduction.
3,105 or 31,500.
Wow. Okay. And an individual? Deduction. Do you know that off the top of your head too?
Half of that.
Half of that. Okay. Yeah. Wow. Okay. That's great. So not only did we preserve the bigger standard deduction, it increased.
It increased.
Okay. Great.
Yeah. Index for inflation. There's a bunch of other things in here. Gosh, we can go through a number of them, but the state and local tax deduction has been a big pain point, especially for folks who own a lot of real estate and folks that live in high tax states. So,
and did that get reduced? That SALT cap was 10,000. When did that happen? Do you remember?
Tax Cuts and Jobs Act.
Okay.
Reduced it to 10.
Oh, how dare they?
And so, yeah, folks that would pay a lot of property taxes or have really high income taxes because they live in a state that has a high tax rate. What's changed with OBBBA has made it much more beneficial. And honestly, it's probably going to help folks that own real estate more than high income earners because there's an income phase out.
Right.
And this creates a really big planning opportunity for folks because if your income as a couple is over $500,000, you start getting phased out of this $40,000 SALT cap deduction.
So it used to be 10, moved up to 40.
To 40.
But once your income goes over 500,000, starts
getting phased out.
Okay.
So for every dollar above 500,000, you are losing part of your deduction, which effectively puts you in a 45% marginal tax rate for a couple filing joint that has $40,000 worth of state and local taxes.
Okay.
In Georgia, for most of our clients don't have $40,000 of state and local tax if their income's below $500,000.
Sure.
There's, for folks that own a lot of real estate, that's the
it's going to make a difference.
That will make a difference. Yeah.
I've been reading this book called Tax Free Wealth. Robert Kiyosaki, CPA, wrote it, and he talks a lot about how much of the tax code really gives you instructions for these deductions and itemization. And it's really business owners and investors, specifically real estate investors, that can take advantage. There's so much in the code, like over 2/3 of this 4 million word, tax code. It talks about deductions and itemizations. And so now we've added, I guess, to it with the OBBBA with the SALT thing. But again, it's really incentivizing real estate investing, and there's specific kinds of real estate investing gets even more incentives, but keep going.
So yeah, the state and local tax, that's a big one. There's some things like the child tax credit. So that would have phased out. It was at $2,000, per child. It, instead of getting phased out, it was supposed to end or get phased down to pre-Tax Cuts and Jobs Act, where it would have been $1,000, per child. Instead, we got to keep the $2,000 with an inflation adjustment, so it's $2,200 per child. So that's a tax credit. That's not a deduction. That's dollar for dollar credit.
Nice. We like those.
Oh yeah,
much better.
So that's a big win for families. Something that's really interesting, I think, is the way charitable deductions are going to be handled after this year.
Tell us more about that.
So starting next year, this new tax bill should be called like the Investment Advisor's Job Security Act, because there's so many nuances in here.
Just the fact that they're making changes all the time gives us job security. It's like, who wants to keep up with all that? Just have your financial advisor keep up with it.
Oh my gosh. Certain provisions are in effect this year. Certain provisions go in effect next year. Some of them phase out over the next 4 years. So there's a lot here, and it's hard to keep track of like when things start and, when things phase out. But anyways, for the charitable deductions, starting next year, there's going to be a hurdle rate. So most people are probably familiar with the hurdle for being able to deduct your medical expenses.
Right.
Medical expenses have to exceed 7.5% of your adjusted gross income
Right.
for
Before you can deduct
medical
expenses.
That's right.
Right.
Starting next year, there's a 0.5% of your AGI hurdle. So in other words, we'll make the math easier. If your AGI is $100,000,
right,
0.5%, okay, $500. So the first $500 worth of giving is non-deductible.
Okay, you got to give away more than 0.5,
and that assumes you itemize.
Okay,
and so it's the amount over that, just like the medical expenses are.
Right.
So then another part for high income earners, if you're in the 37% tax bracket, starting next year, they're going to reduce the value of your charitable deduction by 2/37. In other words, the benefit will be at the 35% rate versus 37%.
Interesting.
So
it's not very nice.
I know, right? It's like, come on. So there's
nickel and dime in there.
There's
Bummer.
the 0.5% hurdle. Now they're going to reduce it where the benefits at the 35%.
I don't like de-incentivizing giving at all, but I still know that a lot of people would give even if there wasn't a tax benefit, but it certainly helps.
I think the concession was whether you itemize or take the standard. If you're giving cash for a joint filer, there's a $2,000 below the line deduction.
Okay.
So it's kind of this whole new category of deductions. Traditionally, like we think of a deduction as either being above the line. So
right.
You have your total income.
Whether you itemize or not.
Right. Whether you itemize or not. So total income, then you have above the line deductions like HSA contributions, pre-tax 401k, your health insurance premiums. They lower from your gross income down to your AGI. Now, from your AGI, that's where a lot of like tax credits and deduction, like phase outs, that's the number that's based off of. So you kind of have a little bit of control on what your AGI is by some of these above the line deductions.
Mm-hmm.
That AGI is a key number. And then we call that the line. Below that would be below the line deductions. So
that's when you're itemizing.
Right. That's, mortgage interest, state and local tax,
mm-hmm.
charitable, medical, if it's over 7.5% of your AGI. Those are traditional below the line deductions. And now there's a whole category of deductions that are below that, whether or not you itemize or take the standard. And so this $1,000 for single filers, $2,000 for joint filers of cash donations is now a below the line deduction.
Oh, brother.
There's a few others that are.
This is also a CPA and tax preparer Job Security Act,
That's right? That's right.
Okay. So there's a couple changes there around giving. You can continue to share more. Yeah, go ahead.
From what I understand is that it has to be a cash donation and it cannot go to a donor advised fund. We have a lot of clients that take advantage of donor advised funds. And so it's something we need to start thinking about with our clients. Are they just barely giving enough to get over the standard deduction based on their situation, which, hey, the standard deduction is so large that you actually have to, for most people, give away a lot of money before it's beneficial to itemize.
Right.
Should we be telling our clients to actually give cash instead of donating securities to these donor advised funds? Because now it can be the below the line deduction.
Got it. Yeah. Okay. So bottom line is that there's strategy when it comes to your taxes, not just your investments and how you're being generous. Right. So we're always encouraging our clients to be generous because it's so purposeful and meaningful and just makes life so much better for the giver and the receiver typically. But depending on how you give, whether you're giving cash or stocks or through a donor advised fund or not, really is going to depend on the amount and what the current tax code is.
That's right.
Get to keep up with that. So let's switch gears, maybe talk a little bit about the estate plan changes in the big, beautiful bill. And then we kind of land the plane here.
Gosh. Yeah. So we had clients that were really pretty nervous about whether the estate tax exemptions would get maintained at the current levels that they've been. Well, they actually just got upped. They got up to.
We're worried about it going away.
Yeah, 15 million per individual. So
Right.
if you're married filing joint, that's 30 million. It's going to be indexed for inflation. So those worries have gone away.
That's great.
And yeah, so still, as far as like estate planning strategy, if that's a potential concern, you've got your annual gift exclusion. So go ahead and you could give up to $19,000 per recipient. So like, if you're wanting to gift money to your kids, it could be $19,000 each, and that's per spouse. So really it's double that.
Right.
There's that summarizes really, I think, the big changes from estate planning
side. Yeah.
We didn't cover the kind of some other temporary provisions that made some like headlines.
Yeah, go ahead.
There's the no tax on tips. Now it's only cash tips, and it's up to $25,000, and there's an income phase out.
Right.
So, I think a lot of people got really excited about this. And it has to be a job that's customarily paid by tips. So, you can't start
doing that here.
You can't start tipping your advisor. I mean, we'll gladly accept it, but but it has to be a job that normally is compensated through tips. And there's that $25,000 limit for joint filers, $12,500 for single filers. There's the added senior tax deduction. So if you're 65 or older, it's $6,000 per individual. So you file a joint, it's $12,000.
Nice.
But that phases out as well. So if your income, if your AGI is over 150,000, you're filing a joint tax return, you start getting phased out of that. So if you and your spouse are over 65, for every dollar that counts towards your AGI over 150,000, you're reducing this deduction by 12 cents. So it effectively is kind of like the cost of having that additional income is a little bit higher.
Gotcha.
And that's where we as advisors should think, well, how should we optimize this distribution strategy for a retiree? Should we pull a little bit out of Roth, try to keep that AGI below 150?
Right. So then I'll get phased out of that.
That's
$6,000.
right.
Yep.
Right.
Yep. More strategies there. So, well, as we wrap this up, you're kind of mentioning some of these very specific things, like just now about the distribution and trying to help on the income when they're retired. So maybe explain how Goodwin Investment Advisory helps clients navigate these decisions, especially with like these temporary provisions.
Oh my gosh. Yeah. So we need to know your situation. Like if you're, whether you're in the accumulation phase or distribution phase, like we need to get to know, if you're considering hiring us or some other advisor, like we need to know your situation, know what your resources are, when the timing of your income is, and we want to try to help optimize that so that you're getting to take full advantage of some of these deductions.
Right.
Some of these are only here for the next 4 years. Like the senior deduction phases out over 4 years. The no tax on tips and overtime phases out over the next, goes away after 4 years. So.
Yeah. And my advice to the listeners would be, ask your advisor to help strategize on your taxes.
Yeah.
We can do that. If your advisor is not helping you do that, you might want to find one that does, or see if you can get your CPA or a tax advisor to help you. But you really, it's worth trying to better understand the tax code. Because the more you understand it, the more you're going to be able to save on taxes.
Absolutely.
So much more of the tax code talks about how to take advantage of these itemizations and the deductions than even talks about what the taxes are or the raises. So if you if we're just like whetting your appetite here for the OBBBA, we do have a great blog on this that Tara wrote. Shout out to Tara, understanding the new tax law, what OBBBA could mean for you. So you can OBBB, you can either sign up for the blog. And if you are signed up, you'll have this in your inbox already. And if you can go to the show notes and get it, or you can go to goodwininvestment.com, click on Knowledge Center.
We didn't cover it all. Like there's other provisions in here.
Right. Oh gosh. I know you guys are real disappointed that we didn't cover all the changes in there, but yeah, there are more. We just kind of picked out a few of them. So check it out on the website. If you want to begin the conversation with us, you can do that by scheduling a call at goodwininvestment.com. Justin, I love signing off with gratitude. just kind of sharing what we're grateful for. I just want to share, what I'm grateful for is mentors and having some local mentors that I get to have lunch with or maybe breakfast with or something. And just to have access to folks that really inspire me. And a lot of times they're just really, really generous. So I need to make sure they know about these changes in the bill, about their generosity. But I'm just grateful, like you were sharing about friends and things like that earlier, that I've got some mentors as well that are really inspiring. What about you? What you grateful for lately?
Man, I got to spend some time outdoors this past weekend, and the cooler weather, the little teaser on the middle of the summer. Gosh, super grateful for some cooler days.
Yeah.
Looking forward to the fall.
It was so miserable to get outside before that, so it's just nice to be able to just get outside and enjoy fake fall for a little while.
Yeah, fake fall.
Yeah. All right. Well, thanks again, Justin, for coming, and thank you, listeners, for joining us today. And if we can help, let us know. Otherwise, have a great day. Bye-bye.
Thank you for tuning in to the Money Pig Podcast. We hope you enjoyed today's episode. To stay updated on new episodes, be sure to subscribe wherever you listen to podcasts. If you found value in today's discussion, we'd greatly appreciate it if you could leave a rating and review. If you have any questions about the topics we covered, feel free to visit us at goodwininvestment.com and reach out. This episode is produced by evance.net. This podcast is provided for informational purposes only and should not be considered as investment advice, a solicitation to buy or sell any financial products, securities, digital assets, or other investment vehicles, nor as a basis for making any financial decisions. Goodwin Investment Advisory is a registered investment advisor with the SEC, CRD number 131193. Please note that the host and or guests may personally own securities, digital assets, or other investments mentioned in this podcast. Investments carry risk and are not guaranteed unless stated otherwise. We strongly recommend consulting with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategies discussed in this episode. Lastly, past performance is not indicative of future results.